Yes.
Characterize the difference of ordinary losses between a subchapter S corporation and an LLC.
All right. So an ordinary loss is the loss or the profit in an LLC or an S corporation. Any pass-through. Those are the two most common. Those losses will flow through on your individual K-1 you will receive from your investment. That is a tax form. Think of it like a W-2. Okay? If it is in a loss position, whether it's an LLC or an S corp, doesn't matter. Okay? That loss would be reported on your individual income tax return and offset other sources of ordinary income. I got to caveat that for a minute. So if you have other sources of ordinary income like wages, and let's say you have wages of $300,000 and you have an ordinary loss on that K-1 of 10, right? You're only going to be taxed on $290, taxed on the collection of your income and your deductions. One thing I want to mention. Even though you have that loss in your K-1, there's this provision called active versus passive. Every investment I've made, I'm passive. Passive. I'm not actively managing the company. That's not the case for every deal that someone is on. Few of you are on boards of these companies. You're making management decisions. I would say you're active. You have the right to contract on the company. You're spending more than 500 hours on the company, things of that nature. Most that I do, I have no bandwidth to actively do it. I'm passive. So I'm limited to the other forms of passive income. Well, if I don't have other forms of passive income, it gets suspended. So I can't use it that year. And if I never have passive income, that amount will accumulate each year until that asset is written off. It divests.
Forever.
Yes. Okay? Does that make sense? That's where it gets complex. Oh, I got this loss in my K-1. Just because you see that doesn't mean you can deduct it. You have to be active in that business. Okay? Which goes to the question, well, maybe LLCs and S corps maybe aren't as attractive if it's a passive investment. It's a valid point. However, I would tell you that if you have other sources of passive income, it might be worthwhile to look at an LLC structure versus a corporation. All right. So if you have rental property, for example, and it's cash flow positive, you got profit from that activity. Does that make sense?
But if that company ceases to do business, aren't you then allowed to take that passive loss?
Yes. So they'll accumulate over time. So if you have 10 years of $10,000 losses, you have to wait until 10 years until that activity liquidates. Make sense? And then you'll have a $100,000 loss that year, regardless of any forms of other activity. So it's important to know. Good question. Anything else? But getting back to this, I said if you remember 3 things about a corporation, these are the 3. And the 1045 rollover can be very attractive. I've done one myself. I'd love to do a lot more because that means you have a lot of successful transactions. But 1045 is it can be a real opportunity because you have a significant gain and you want to continue to invest. This is where corporations, and this is only available to corporations, can be very advantageous. I want to mention a couple other things real quickly here because I could make this a 4-hour day. One of the things that people like about corporations, they provide a lot of flexibility for key employees. So as an organization starts to mature, what I find with technology and life sciences companies or companies that are looking to go public, and I did an article actually, an interview yesterday with the Courier on why companies are going public, what forces them. And largely, the number one reason is the list of buyers is pretty short, right? They reach a certain size and scale where that list of buyers is so far and few between, that's the next best liquidity option. And so that may be one of the reasons why companies go public. But the opportunity for ISOs, incentive stock options, are attractive to employees because they're going to get more capital gain. They'll be taxed at a lower rate than they would under non-qualified stock options.
Brian, the one thing I would say on the, and again, we could get in the weeds on all this stuff, and I'm sure you don't want us to, but on the incentive stock options, the one thing I would say there is that's another one where, in the right circumstance, that is a really tax-efficient way to incent an employee. For a lot of startups, the reality is it doesn't really work because, again, without diving into the weeds, one of the things you have to do to be an effective ISO and to get capital gains treatments is after you exercise that option, pay in the exercise price and buy the stock, you have to hold the stock for a year before a liquidity event. And the practical reality of how most startups go is if they're selling their business, nobody's going to write a check to exercise that stock option until the day before the liquidity event. In fact, reality is most deals, the stock options are never exercised, and there's just a straight cash transfer at closing for the net value, which blows the ISO exemption. It's not necessarily a bad thing. It just converts you back into a non-qualified option. So it's not like a disadvantage of a corp, but I would say, to me, the two sort of things that you'll hear from some folks about why you should be a corporation would be the 1202 that Brian mentioned, and then this ISO treatment. I would say both of those are overrated.
And you could be an LLC taxed as a corporation
Correct.
and still get ISOs. That was
Correct.
a question that came up to me recently that I didn't know the answer. I had to look it up. So corporations are simple. I mean, not necessarily in the formation at the beginning, but I mean from a purely tax perspective, a lot simpler. I get much more calls on LLCs, a lot of complexity there, a lot of flexibility in an LLC than a corporation. And those are the primary drivers. I want to mention one thing, and I'm going to go off topic as I usually do, about incentive compensation where you're giving equity away. Everyone has their own personal preference. I have mine. I like SAR plans, stock appreciation right plans, and phantom. Make them phantom. So they get units. You give everyone units, but these are phantom units. So it feels like equity, but it's not giving it up because it can create some pretty significant dilution options as opposed to some of the other kinds of plans that are out there. I'm doing much more SAR plans than ever before. They're formula driven. You got to be careful. I had a circumstance come up late last night where there was a redemption. Two principals went from 100,000 units down to 65. And the formula was these phantom units divided by the number of issued and outstanding units. Well, they just almost doubled the value of their, through a redemption, right? Double the value of their interest. So, and there were provisions in the agreement that discussed this, but we needed, went quite as tight as we had hoped they would be. So we have to make some amendments. But keep that in mind. That comes up a lot with a lot of venture-backed deals. This question of employee incentives, and I'm a real big fan of SARs and MIPS and things of that nature, and phantom plans. It just makes things so much easier. I'm in the middle of 2 business divorces, mediating them, and that's my least favorite job I ever get. So keep that in mind.
No, the SAR, and they go by lots of different names, but effectively a SAR or a phantom stock plan is really a glorified bonus plan. So it's a contract right that says we agree to pay you, employee, a certain amount, and it could be tied to the value of the business on liquidity. It could be tied to a formula, as Brian said. But from a tax and legal point of view, it is a contract right. It is not an ownership interest or a right to an ownership interest in the company. It's taxed just at ordinary income rates, but you don't pay the tax till you get the money, generally speaking. So it's a deferral,
by the corporation.
and you get a deduction. So I'm a big fan of them too. I think the challenge we have is in selling them. Frankly, is venture capital investors are so used to the stock option, and it even though it gives you much of the same treatment, and in some ways is even, I think, better than a stock option, it's not kind of the tried and true. So I would say we talk about them more than we convince people to do them, but we're a fan of them as well.
I can be pretty convincing,
Brian's more convincing than me.
Except for the institutional VCs, I just say yes, sir, yes, ma'am, and we move on. But this is where in a corporation, these are the kinds of things that I tend to find are the most common questions, if you will. Any questions on a corporation?
Yeah, Delaware versus everybody else.
Yes, I'll let the lawyer take this one.
So, what's the question is what state to incorporate your business, Delaware versus Ohio or Kentucky or what have you.
Sure.
So I think the actual differences between those are overrated. The Delaware has much more well-developed case law. There's a lot, if you ever get in a fight with somebody in Delaware, you're going to find a lot more sort of, what are the rules. That said, most other states follow Delaware laws, rules anyway, even if they don't literally, they're going to look to those cases. So I think the actual differences are overrated. The reality is almost all institutional venture capital investors want to invest in Delaware corporations. And again, we lawyers like to debate the reasons for that, and we don't think they're, very good ones, but we're talking to ourselves. They want to invest in Delaware corporations.
They're lazy. It's a lazy man's rule.
Well, it's the tried and true. So we need to get rolling here. So Brian, you want to hit that? Maybe we talk about a lot of this
and I'll
quickly.
briefly hit on this too. And
Yeah.
LLCs and special allocations. The beauty about LLCs is you can have special allocations. James and I form a partnership. He's contributing property in there that we both agreed it's truly property worth $1 million. I'm contributing $1 million in cash. I can say I want the first $1 million of losses, and I can do that in an LLC, right? So you have a lot of flexibility in terms of special allocations. Generally speaking, you either contribute one of three things to an LLC: services, future services, property, can be intellectual property, not know-how. That's a big no-no to me when I see an operating agreement that says, so-and-so, Jane is contributing know-how. Well, and they list it as property. Know-how is not property. I really think you have to, if somebody's contributing property, put some form of fair value and identify what that property is. What is that property? Know-how in itself should not be property. And then cash, of course. The benefit, again, as I mentioned before, is you're getting these K1s, you're getting the losses on an annual basis. If you have other forms of passive income, or you're active in that business, actively helping that business, you get the time value of money. You're able to take those losses in the current year. It's a benefit of an LLC, why it makes a lot of sense. Certainly for early transactions that are capitalized by venture or private capital, that can be advantageous if you have other sources, again, passive income, or you're active in the business, okay? The other thing we talked a little bit about, sometimes this comes up a lot. Again, I prefer other things, but we have this profits interest. You see that a lot. You have a key employee or somebody coming in at the inception. A profits interest works very much like a share appreciation right, but it is actually a unit. It is actually a physical unit you give to somebody. It's a common concept that you see out there. If you're giving somebody a capital interest, a unit, just a regular unit in exchange for future services, whatever it means, that's a taxable transaction. A profits is not, because it's an appreciation right. So the company's worth $10 million, and you give them one unit, they effectively participate, and one unit is 1 of 100, 1% of the appreciation in excess of $10 million, in my example. It's an appreciation right. Make sense? Anyone drinking water out of a fire hose yet here? Anyone? All right. All right. Complexity, these things get really, I get more questions on partnerships than anything.
I would say my kind of 10,000-foot view on the LLC versus corporation question is we generally start with LLCs for kind of brand new companies, not always, but often, because it preserves flexibility. It's easier and we'll talk about conversion in a minute. It's generally easier to convert an LLC to a corporation. It's pretty hard to go from a corp to an LLC, so it preserves some flexibility. But LLCs do create accounting and tax complexity. Or can, if not structured right. So this is going to sound like a sales pitch, but I'm going to say it anyway. Get a good accountant if you're setting up an LLC, because that's the one place where we run into trouble.
Yeah, and that's where the allocations. You have to have questions with your CPA on. They really need to understand this, because we have a situation. Well, can I just harvest everyone's losses?
Yep.
The reality is you can only harvest losses in fields you plow. Remember that. So if you haven't put much into it, it's hard to bank all these losses that are other folks' money. Okay, there are regulatory provisions that are in place that preclude that. I don't care what the operating agreement says. The operating agreement can violate the regulatory environment. It happens. I've seen it. So just remember that. Okay.
Yep. You want to hit this?
Yeah, I'll hit this real quick because this comes up a lot. It's very common that an LLC needs to convert to a corporation because you have some form of an institutional investor that requires it. OTAF is one here. All right, is that right, Tony? OTAF requires? I believe so. So this happens a lot, and be very careful because if you don't do it the right way, it's form over substance. You can create a little bit of a nightmare on yourself. And also remember those benefits of 1202, originally issued stock, is one of the provisions for 1202, 1244, and 1045. So anytime somebody says, how do we do this? There's three approaches, but generally see what's called an asset up or an asset over. Asset up, what happens is you distribute out all the assets and liabilities out of the partnership to the individual members. They turn around and they contribute it up to the corporation in a tax-free manner, right? That's how it works. And an assets over, it's as if the partnership took all the assets and liabilities, threw it over to the corporation in exchange for stock, and then the stock is distributed out to the owners and the LLC goes away.